The top business stories live from the Sky newsroom. The Prime Minister's U-turn on planned welfare reforms could cost £3 billion more than planned, leaving a hole in the public finances. The US benchmark S&P 500 index reaches an all-time high, rebounding after a sharp drop following Donald Trump's global tariffs. And as Glastonbury gets underway, we'll take a look at how much music festivals contribute to the economy. Good afternoon. This is Business Live with me, Paul Kelso. Just to mark your card, we are expecting Donald Trump to speak from the White House in the next few minutes, reacting to the Supreme Court decision you've been hearing about a little earlier. As soon as we see the president or any of his team, we will take you directly to that. But before Mr. Trump, let's look at the British economy and the impact today of the Prime Minister's decision to back down over planned welfare reforms. It's a blow to his political authority, but it may come at a price for the government's economic credibility too. A policy intended to save £5 billion at the last budget could now cost £3 billion more than expected, leaving a hole in the public finances the Chancellor will ultimately have to fill. Let's remind ourselves of the numbers here. The original forecast by the Department of Work and Pensions was that, left unchanged, welfare spending would balloon from £51 billion today to nearly £70 billion by 2030. That's the blue line there. Under the government's plan, the original plan, that increase would have been reduced by around £4.5 billion to just over £65 billion. But following this U-turn, the Resolution Foundation predict the welfare bill will be £3 billion higher than that, a saving of less than £2 billion. And note, in both of those scenarios, they only slow the rate of increase in welfare spending. They don't go anywhere near reducing that spending. But those are the numbers. Joining me now to discuss them is Dan Boardman-Weston, Chief Executive, BRI Wealth Management. I've gone into some of the specifics there, Dan. I wonder, for markets as they're considering investing in the UK, lending to the UK government, whether the overall message is perhaps more important than nitty-gritty of a few billion here and there.
I think you're right. I think it is the messaging. Countries across the world are grappling with large fiscal headwinds as the cost of debt has risen significantly over the last few years, and the overall debt burden has. And whilst, as you say, an extra sort of $3 billion of funding is not a huge amount, I think symbolically it is, and all eyes now will look towards the autumn statement or the budget to see where Rachel Reeves will have to raise taxes from, because we've already seen significant departmental spending cuts, and so it is likely that tax rises are coming. Where they come from will be of interest.
Have we seen any significant move in bond markets today to this, or have the government ridden this out as far as the markets are concerned?
Yeah, they've crept up a little bit today, but nothing too alarming. But 30-year borrowing costs in the UK are still incredibly high at 5.3%, 10 years at 4.5%. And so there needs to be a credible fiscal strategy going forwards, and these repeated U-turns and lost sort of hope and sort of false promises over the last year does nothing for the fiscal credibility of the UK.
Of course, that was Labour's big promise and the Chancellor's big promise, and they still talk about it now. No repeat of Liz Truss's mini-budget, which did so much to damage confidence. But I wonder how much of this is a product of how tightly the Chancellor has painted herself into a corner, promising no tax rises on the main personal income taxes, loosening the borrowing rules, but then going right up to the edge, so that now she appears to be going from budget to budget, having to make little cuts, relatively speaking, that are politically difficult and perhaps putting markets on edge too.
Yeah, they excluded in their manifesto about 70 or 80% of the tax take. They said they weren't going to increase those taxes. So it leaves very little wiggle room. And in the March statement, Rachel Reeves only left herself about £10 billion of fiscal headroom. Now, clearly, some of that has gone with the welfare U-turn and with the winter fuel allowance U-turn, but also with Trump's tariffs. Clearly, the UK and the global economic outlook is significantly different than it was in March. And so she is going to have to come back in autumn with some tax rises. And I don't know where they will come from, but I suspect certain promises will have to be broken.
And you don't see any alternatives to that? You don't see growth riding to the rescue, because that is sort of one of the alternatives. You can cut spending, you can raise taxes, or you can generate more revenue because the economy is expanding.
I don't see it in the short term. I think business confidence is not good. Businesses have been hit by an increase in the minimum wage and the national insurance increase in April, and consumers are just saving money. I mean, they're not spending money. I mean, retail sales were pretty awful in May, and the UK savings rate is up at about 12%, which is a very high level. So, in the short term, I do not see growth riding to the rescue. I think there's a wider point about the fiscal rules. Now, we clearly need fiscal rules as a nation, but whether the ones we've got at the moment are fit for purpose, I think, is a debate that needs to be had.
Just very briefly, Dan, when we think about the markets, are they agnostic about how the books are balanced? Will they mind if it was tax rises, if clearly set out, or spending cuts, no matter where they fall?
I think broadly speaking, they would be agnostic about that, with the caveat that if it was to be funded by tax rises, what impact would that have on UK business investment and sort of business growth, and whether that would have a knock-on impact on hiring and employment and the general economic output. But I think that markets want to see a credible fiscal plan and governments taking the tough decisions to balance the books and also try and grow the economy. Now, I know that's a tough ask, but Labour should have the majority to do this, and I hope they can manage it.
Indeed, and it's the job they asked to be given, and now they've got it. They've got to deal with it. Dan Baldwin-Weston, thank you very much for your time this afternoon. And if you scan the QR code on your screen now, you can read more on that and many other stories on our excellent Money blog. Now, some other stories now. The United States benchmark S&P 500 index has reached an all-time high, rebounding after a sharp drop following Donald Trump's global tariffs. The S&P 500 rose 0.3% in early trading, beating its previous peak on the 19th of February. That might be a response to news from Beijing that a framework agreement to de-escalate trade tensions with the White House is taking shape. And comments this afternoon from US Treasury Secretary Scott Bessent that trade talks could last into September. That raises the prospect that Donald Trump's July tariffs deadline could be extended. Now, Sky Group, the owner of Sky News, has sold Sky Deutschland to multinational media conglomerate RTL Group for an initial 150 million euros that could rise to more than 500 million euros. The acquisition, which will see RTL operate the Sky brand in Germany, Austria and Switzerland, is the largest transaction for the RTL Group since its inception 25 years ago. Dana Strong, the chief executive of the Sky Group, spoke to employees at Sky Deutschland's offices in Munich this morning.
The power of having 11.5 million streaming customers, the unbelievable assets of Sky, combined with the RTL portfolio of entertainment products, news products, big shows, reality shows, it really started to I guess you'd say the industrial logic became really clear to us, and we realized that this was the best possible way to scale this business, to diversify it, and set the business up for future growth. So we think this is an exceptional opportunity, and we're really, really excited about the future.
Now, UK car exports to the United States fell by more than half last month, according to industry figures. The Society of Motor Manufacturers and Traders data shows UK car sales to America fell 55.4% during May, following a decline of just 3% the previous month. All of that, of course, under the threat of tariffs rising to 27.5%. Let's bring in Ian Plummer, Commercial Director at Auto Trader, to help us with what this is telling us. As of next week, those tariffs will fall to 10% under the trade deal Sir Keir Starmer's done with Donald Trump. That's the best deal anyone in the world can claim at the moment. Are these numbers perhaps giving us an idea of quite how serious this would have been for the UK car market?
Well, they certainly are. It's definitely a major issue for the car producers over here if they can't ship to their second biggest market. The EU is the first, the US is the second. They've fallen from being roughly worth a fifth of UK car exports to a tenth in this period. But this period is probably even worse than it would have been if we'd have actually applied the tariffs at that level, because actually manufacturers had to pause their deliveries into the US for this period. So they're significantly down because people like JLR and other manufacturers over here, Aston Martin, actually stopped exporting for a period of time. So there's a sort of freeze on things. No doubt they would have been significantly impacted if the tariffs have been applied, and they will still be impacted because there is a 10% tariff, which is far higher than it was, much better than it could have been, but it's still not ideal, clearly, and it's going to impact the brands in question.
Yeah, those 10% tariffs that are going to be there, as you say, the position is worse than it was, but not much we can do about that given the president's approach. Can the British manufacturers ride that out? Are these products popular enough? And frankly, they're expensive, many of them to start with, aren't they?
They're certainly popular. They're hugely popular. These brands I've just mentioned, a couple, there are others built over here, Rolls-Royce, Bentley, etc. They're high-value products, clearly. It goes with the names, doesn't it? But they're extremely popular in the US market, highly sought after. Some of these products, especially at the higher end of JLR's range, Aston Martin and so on, they are clearly selling to less price-sensitive consumers than people buying mass-market products. Some of the price effect may be passed on to the consumer. Some of it will likely be absorbed by the brands. There'll be other sources of saving that they'll look to make. There'll definitely be impacts across the board and potentially some impacts in the supply chain. So what's fantastic to see, fundamentally, is that we do have this deal. I think there is optimism, nonetheless, that these brands, because they're so popular, they do have some great cars, can ride out the storm ahead, and hopefully weather things positively at the end of the day.
What is it about British cars that work so well in the US? We've heard lots from the president and others about wanting American cars to be sold into Europe. There's a great pride in they buy different kind of cars, don't they? The truck is the best-selling vehicle. What is it about particularly the higher-end British brands that chimes so well with American consumers?
Well, there's definitely a prestige factor in the case of the two brands I've quoted already a couple of times. But if you look at the likes of Rolls-Royce, seen as a quintessentially British brand, part of a German group right now, the likes of Bentley, similarly part of a German group right now, the Germans equally have a huge prestige factor in the US market and worldwide. So I think there are still plenty of wealthy Americans able to do very well just now. The market's been up and down, as we all know, but they're faring pretty well just now. So I think the affordability factor is still there in the American market, and their taste for these luxury products is still riding high. So they should be able to, I think, and I hope, ride out the storm and see some positive numbers in the months ahead. It's important they do, because these industries are vital. They weigh about 12% of the value of all the goods that we export around the world, cars, and they account for around 200,000 people employed in manufacturing, 800,000 employed more broadly in the sector. So it's a really important sector for the UK. It's great to see that the government's got behind the industrial strategy that has also supported the UK automotive sector, amongst others. So hopefully we see some optimism ahead.
Yeah, lower energy bills coming as a result of that industrial strategy. Ian Plummer, Commercial Director at Auto Trader, thank you very much for those insights. New research reveals that consumers are chucking out 62 million tonnes of electronic waste every year. Figures from tech resale site Back Market suggest we're discarding 5.3 billion electronic devices a year, 80% of which still work. So what is the impact on the environment, and what do these figures say about wasteful consumer habits? Luke Forshaw is from Back Market. He joins us now. Luke, what is going on here? Are people really chucking away phones, devices, laptops and the rest that still work perfectly well?
Yes, unfortunately so. It's a growing problem, and it's a cultural problem in the terms of fast tech. It's a bit of an embodiment of like a disposable mindset where products are made to be replaced and not repaired, which is showing itself through overproduction and overconsumption, which is having an impact on the consumers' wallets, but also on the planet as well.
We're used to built-in obsolescence in certain things we buy that we get the sense as consumers are not built to last. But there's something interesting here in devices that plainly do last, that can cope with endless updates. What is it about that mindset that means we're willing to spend really large amounts of money on replacing things we don't need to?
I think it's part of like the industry setup. Pardon me. We're pushed upgrades, which then subsequently have an impact of planned obsolescence, where, as you allude to, devices that we have, hardware that we have, is essentially made redundant by the software that operates on it. What this means is that we're forced to dispose of tech, and when it comes to e-waste, which is primarily the main component of a lot of these devices, only 22% of e-waste is recycled. The rest, it essentially just goes to landfill. It's highly toxic, and it's the world's fastest growing waste stream, up 82% since 2010. So it's it's a growing problem, and it's one that we've got to tackle quickly.
Has the industry shown any signs of taking responsibility for that and trying to tackle that? I mean, that's a shocking figure about the small proportion of devices that can be recycled. Is the polluter in this case prepared to pay and prepared to do something about it?
Not that we're seeing, unfortunately. Maybe not so much of a surprise, but the money that is made on the back of selling new devices and not keeping old devices in circulation for longer is massive. So the impetus isn't there, and it's on us as consumers and brands to lobby with governments to really reinforce the right to repair legislation across not just the UK, but across other markets as well, so that devices can be made to be kept in circulation for longer. They can be made to be more easily repaired. And essentially this knocks the impact of needing to always buy new, which is better for your wallet, and it's better for your planet.
So what should we do if we don't want to hang on to our, whatever the slightly more up-to-date equivalent of the Nokia brick is forever, but you do fancy a change? How does one go about finding a nearly new, or second-hand, as we used to call it, device? It doesn't seem that obvious as a pretty enthusiastic consumer.
Our level, it often can't be, and it's how we've been, brought up, and how recent years have dictated that new is often the easiest and sort of safest thing to do. But in tech's case, the more sustainable option is often the more affordable option as well. So there's three options and three approaches that we would recommend. First is reuse what you have, make it last longer, and don't spend your money on newer models if you don't need it. So, if your iPhone 13 is still making calls, it's still connecting to the internet, and it lets you doom scroll TikTok, do you really need the 16 Pro? Secondly, repair if you need. The analogy here is if you get a flat tire on your car, do you need to replace the entire car or just replace the tire? So there's companies like Repair Cafe or iFixit that are really helping educate people on how to repair their own electronics. And then thirdly, refurbish. So, you allude to who are the companies that can help shake up the new category. And we would say that Back Market are one of these brands. We allow people